Good evening, students. Welcome to the session. Hope you enjoyed the Diwali, right? In that case, we discussed that when the government acquires the land compulsorily, in that particular case, the taxability happens in the year in which the compensation is first received. So even though the compensation may be received in installments, but in the year when it is first received, that compensation would be taxable along with the future installments also. But in case there is an enhanced compensation which is received later on due to you winning the case before the court, then the enhanced compensation will be taxable in the year of receipt. The interest on compensation will be also taxable in the year of receipt under the head income from other sources. Right? Now, the capital gain will be calculated on the compulsory acquisition. The period of holding for that will be till the time the land is compulsorily acquired, and the indexation will also stop at that point in time. But you will get 6 months period for the purposes of 54 EC from the date of receipt of compensation and not from the date when the land was compulsorily acquired, right? In case of enhanced compensation, the cost of acquisition will be zero. The period of holding will be as per the original asset, right? So this is where we had stopped in the last class. Any question so far on 9B? Yes, students? The 45, which is 45.6. Now, 45.6, just write down first. What is it regarding? This is the last, sorry, 45.5, not 45.6. Section 45.5. This is in relation to joint JDA. Now, what happens in this joint development agreement? Let's try and understand first. See, this is also something, concerning the immobile property. 45.5 was also compulsory acquisition of land. Okay, one more thing in the compulsory acquisition of land, if you remember, I told you, in case the urban agricultural land is compulsorily acquired, exempt under 1037, rural agricultural land is any which ways not capital asset. Compulsory acquisition of land under Right to Fair Compensation Act is also specifically exempt, right? Now coming to 45.5A, let's assume, for example, there is an owner of the immobile property. So let's say there is individual or the HUF who is the owner of the property, right? Now this owner of the property will enter into an agreement with the real estate developer. He will enter into a specified agreement with the real estate developer. Now, there is an agreement, or we call this as a specified agreement with the real estate developer. Now, what is the purpose of this specified agreement? So, 45.5A defines the specified agreement, or let me open up the act for you again so that you are also able to read it. Yes. So specified agreement means a registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share being land or building or both in such project, whether with or without payment of part of the consideration in cash. So what is this agreement for? the specified agreement which is there is where a person who is the owner of the land or building, this is owner of my land and building, right, is allowing the another person to develop a real estate project on such land or building. So this individual or HUF will give the possession of land or building to the real estate developer. And what is the consideration which he is going to get to give the possession of land or building? The share in the land or building. So he's giving the possession of land or building for what? To develop a real estate project. Are we getting that? So this is the owner of the land and building. Who is the owner of the land or building? Any individual or HUF. He is agreeing into, or he is entering into, he is entering into a specified agreement with the real estate developer. What is the specified agreement for? The specified agreement is particularly to give the possession of land or building to the real estate developer so that he could develop a project, a real estate project on that land and building. And the consideration, what he's going to get in return for that is share in this project, or let's write share in this real estate project plus some cash. Now, first of all, students, tell me, is this a transfer under 247? When the individual or HUF will give the possession of the land or building to the real estate developer, is there a transfer taking place? Yes. Is there a transfer taking place? Faster. Go back to the definition of transfer under 247. Yes. What does the 247 says? I'm putting here the definition of specified agreement also for your purpose. Yes, students. What was the definition of transfer under 247? Let me open up that for you as well. Yes, Oja, how is the transfer taking place? Under which clause we will put it into? Let's read the definition of transfer. 247. Yes. Under which clause are we trying to fit this into?
Ma'am, that was in the definition under section 53A was the
Yes.
section.
Yes. Absolutely. So if you see here, students, it says transfer includes any transaction involving the allowing of the possession of any immobile property to be taken or retained in part performance of a contract of the nature referred to in 53A of the TOPA. Isn't it? So here, the definition of transfer includes any kind of agreement where the possession is transferred to the other person, even though the ownership is not actually transferred. So now there is a transfer taking place under 247. for sure. This is a transfer. So you can just write down over here. Transfer under section 247. What is the definition of transfer saying? Any transaction involving the allowing of the possession of immobile property. Right? Now let's say, for example, this happens in the year, let's say 2007, right? And this share in the real estate project may be received many years later, because you know that buildings take a lot of time to get developed. So quite possible that the building is developed, let's say 5 years later, 8 years later. So let's assume, let's say the building is developed in 2012 and the consideration I'm getting in 2012. Now, in which year the taxability will ideally fall into? When will the taxability happen?
Ma'am, can you please repeat this question again?
Yes. So I was asking, when would the taxability happen under the capital gain? In which year you will tax this particular capital gain?
Ma'am, in 2007,
Yes. Why in 2007?
as the transfer is taking place in 2007 only.
Absolutely. So see, Section 45(1) says what? That the capital gain arising on the transfer of a capital asset shall be charged to tax in the previous year in which the transfer takes place. Now, when is the transfer taking place? In the year in which you are allowing the possession of the immobile property to the real estate developer, right? So, ideally, the taxability will happen in the year 2007. But if you see, there is a problem in this case. What is the problem in this case? So if as per 45(1), taxability in the year of the transfer, which is in our case 2007. But if you see, the consideration is being received in 2012. So when the building will get developed, so I am owner of land or building. Now I am giving this land to the real estate developer, the possession to real estate developer, so that he could develop a real estate project on this. Now in consideration, what he will give is, he will give me a flat in this particular project. So now the consideration will be given to me only when the building will be entirely completed. Now, in the year in which the building is entirely completed, in that year, I will get the possession. I will get the consideration to me for the transfer that has taken place. So, in fact, what we are trying to do, even though I have not realized the consideration, I am supposed to pay tax on that in the year 2007. So, I am realizing my consideration many years later. But the taxability is happening in the year in which the possession is being transferred. So this will genuinely cause the hardship to the individuals or HUF who are giving the lands to the real estate developers for developing the real estate project, because they have not yet realized the consideration, isn't it? So in order to avoid the hardship for them, 45(5)(a) is a specific charge. So what does 45(5)(a) says? That the taxability will not happen in the year of transfer, but in which year is what they are saying? In the year in which the completion certificate is received. So let's go back to 45(5)(a). It says, notwithstanding anything contained in subsection 1. So meaning it is overriding the section 1. Where the capital gain arises to the Aati, being an individual or HUF, from the transfer of a capital asset, being land or building or both, under a specified agreement, the capital gains shall be chargeable to income tax as the income of the previous year in which the completion certificate for the whole or part of the project is issued by the competent authority. So when the building will get finally completed, in that year, the taxability will arise. So 45(5) says, taxability in the previous year in which completion certificate is issued by the competent authority. Are we clear? Now, what are these completion certificates? See, the municipalities issue these completion certificate to the builders that, okay, now the project is entirely complete. So, once they get that certificate, when the certificate is issued by the competent authority, in that year, the taxability will arise for the individual or HUF. Now, let's go back to again section 45(5), what it says further. And for the purposes of section 48, the stamp duty value on the date of issue of the said certificate of his share, being the land or building or both in the project, as increased by any consideration received in cash or by check or draft or by any other mode, shall be deemed to be the full value of consideration accruing or received or accruing as a result of transfer of capital assets. So what they are trying to say is that how will you compute the capital gain? So my full value of consideration will be the stamp duty value as on the date of the completion certificate issued. As on the date of issue of completion certificate will be my full value of consideration. So this is the computation of my capital. Minus, of course, my cost of acquisition. Cost of acquisition will be my cost of land or building. So this is the SDV of share in the project. Because he will only get one flat, right? Or one particular unit, or one shop, or one bungalow, something like that. Okay. So the SDV of that particular flat or bungalow, whatever he is receiving, will be my FVC. Minus the cost of acquisition, you will get the period of holding, indexation on the normal basis. Are we clear about this? Yes? Any questions so far? Yes or no? Okay. Now, what will be my period of holding or indexation over here? What will be the period of holding or indexation over here? Here you can also write plus the cash consideration. See, cash consideration does not mean only the amount received in cash. It will also mean amount received through the banking modes. Because earlier, there was one interpretation, cash consideration means only the cash amount. It's not like that. Cash will also include the banking mode transfer. Yes. Till what time you will give the indexation or what will be your period of holding? Will it be till the time you receive the share in the project, or will it be till 2007? What will be your period of holding on indexation? Yes. What will be my period of holding? Will it be till 2007 or will it be till 2012? Till the date of transfer of his share. Vignesh, then of which year you are saying? Can you give me the specified year? 2007 or 12? Okay, 2012. Anybody thinks 2007? Yes. See, the capital asset ceased to exist in 2007, right? I have given my possession of land in 2007. So the capital asset is parted up, right? So I will get period of holding or indexation till 2007. So till the possession is parted. Till that point, I will get the indexation or the period of holding. Are we clear? Any questions so far? Okay. Now let's see what 45(5) says further. It says, provided that the provisions of this subsection shall not apply where the assessee transfers his share in the project on or before the date of the issue of the said certificate of completion. So it says that this 45(5)(a) will not be applicable in case the assessee transfers his share in the project before the date of issue of the completion certificate. So in that case, what would happen? If I am saying that 45(5)(a) is not applicable, if I transfer my share in the project before the date of issue of completion certificate. Let's say I have sold the flat which I have received in the project before 2012. Then in that particular case, what will happen? 45(5)(a) will not be applicable. If 45(5)(a) is not applicable, then in which year you will consider the transfer? Yes. So I am saying there is an exception to this. The exception is if the share in the project transferred before the issue of completion certificate, say before 2012, then the capital gains shall be taxable in which year? In which previous year the capital gains will be taxable? Now 45(5)(a) is not applicable. So in which year the capital gain will be taxable? Yes, Prashant, in 2007. Because then if 45(5)(a) is not applicable, it will be taxable as per 45(1). And 45(1) says what? 45(1) says that the taxability will be in the year of transfer. So it shall be taxable in the previous year of transfer, which is 2007. In that case, What will be my FVC? See, when 45(5) is applicable, FVC is the SDV as on the date of issue of completion certificate plus the cash consideration. Now, if 45(5) is not applicable, what will be my FVC? What will be my FVC then? Think about it. Yes, what will be my FVC? FVC will be the stamp duty value as on the date of transfer as per section 50C. You have learned section 50C in IPCC also, isn't it? So, in case of transfer of land or building, you take the stamp duty values, right? So, you will apply the provisions of 50C, which are the general provisions in case the 45(5)(a) is not applicable. Are we clear about it? Now, what will happen? Let's say, for example, when the share in the project is sold. Let's say I have paid the tax under 45(5) and now I'm selling the flat which I have received. So in that particular case, my FVC will be my actual sale consideration. Of course, subject to section 50C, right? My cost of acquisition will be this cost. FVC taxed under section 45(5)(a). Because technically you have not paid any cost for that flat. But your FVC was already taxed under 45(5), so you will get this step-up cost under cost of acquisition. Are we clear about 45(5)? Any questions, any doubt? Now on the cash component, there is a TDS under section 194IC. There is a TDS under 194IC on the cash component which is received. See, I'm just trying to link both the chapters so that you don't have to study separately that particular point. So on the cash consideration, there is a TDS at the rate of 10%. So on the monetary consideration that you receive, you have to pay a TDS under 194IA. You don't have to pay, sorry, the builder or the real estate developer will deduct the TDS when he will pay you the cash consideration. So whenever the builder will pay to the individual or HUF any consideration in cash, which will include in the banking mode, will deduct the TDS on that at the rate of 10%. Sorry, at the rate of 1%. However, the TDS will only be deducted if the value of the immobile property is more than rupees 50 lakh. But the consideration and the stamp duty value of such property is more than rupees 50 lakh. Are we clear? Yes or no? So you can just write down, sorry, not 50 lakh. One second. You can just write down over here. I was telling you about 194I. Just write down 194C TDS will be applicable on the cash consideration. C. TDS under section 194 IC at the rate of 10%. 1% is under 194 IE. Under 10 IC, it is 10%. Okay. So the builder will deduct the TDS. Yes or no? Fine. Yes. Okay. So this completes your 45 section in entirety. So 45.5 which is there is for the compulsory acquisition. 45.5A which is there is for the joint development agreement where the possession of the immovable property is given. Any questions so far? Now you will see that it took us more than 2 classes to finish just the 45 section, under which the most complicated one was which one? 45.4, which was concerning the transfer of a capital asset on the reconstitution. Along with that, 9B. Clear? Now let's move to the next section, which is section 46. Now section 46 is about what? This is about distribution of assets by the companies on the liquidation. Of liquidation. So see, when a company gets liquidated, right, at that point in time, what happens? It could give the assets to the shareholder, or it could give the directly cash. So what company can do on the liquidation? One thing it can do is it can sell all the assets and distribute the cash to the shareholder. So if it gives the cash to the shareholders, that is one way, or it can give the assets to the shareholder. Right? Now, here it is distribution of assets. 46 covers the distribution of assets to the shareholder. So let's read what section 46 says. So 46.1 says, notwithstanding anything contained in section 45. So 46 is trying to override section 45, where the assets of the company are distributed to its shareholders on the liquidation. Such distribution shall not be regarded as a transfer by the company for the purposes of section 45. So even though the company is giving the assets to the shareholders, section 46.1 is specifically saying that this shall not be regarded as transfer in the hands of the company. So you can write down in the hands of company, not regarded as transfer. This is section 46 clause 1. Are we clear? Then what does clause 2 says? Where a shareholder on the liquidation of a company receives any money or other assets from the company. So it will cover both the money as well as the capital assets on the company. He shall be chargeable to income tax under the head capital gains in respect of the money so received or the market value of other assets on the date of distribution as reduced by the amount assessed as dividend within the meaning of 222C, and the sum so arrived shall be deemed to be the FVC for the purposes of 40. So in the hands of the shareholder, there will be two things which will happen. To the extent, or you can just write like this, deemed dividend under section 222C to the extent of accumulated profits. So first, there will be taxability under the head income from other sources, which will be deemed dividend under 222C to the extent of my accumulated profits. Second, capital gain under section 46(2). What will be my capital gain under 46(2)? My full value of consideration shall be the money received plus the fair market value of the assets minus the amount taxed under section 222C. So this amount you will reduce so that there is no double taxation. Are we clear about this? Yes or no? So this is similar to, the 45(4) that you have studied for the partnership. 45(4) was for reconstitution of partnership. This is 46 for the liquidation of company. In that case also, if you see under 9B, there was a taxability in the hands of the firm, and under 45(4) there was a taxability in the hands of the partnership. Here also it's the same thing. Under 46(1), there is a taxability in the hands of the company, but 46(1) specifically exempts it. 46(1) says that this shall not be regarded as a transfer. So when, of course, a company will distribute the assets to the shareholder, it is a transfer. But 46(1) specifically exempts. When you compare it to the 9B, 9B does not exempt it. 9B taxes it. So there is a distinction between how the taxability is in the hands of the partnerships vis-a-vis in the hands of the company on liquidation. Whereas in the case of the shareholder, when the shareholder receives the amount by way of money or the assets, there is first a deemed dividend under 222C to the extent of accumulated profits. Secondly, there will be capital gain under section 46(2), and my full value of consideration will be what? My full value of consideration will be the money received plus the FMV of the assets as on the date of liquidation minus the amount which is already taxed under 222C. Are we clear? Now, why there is a taxability in the hands of the shareholder? Yes, why there is a taxability in the hands of the shareholder? Can you explain me? As on the date of distribution. FMV as on the date of distribution.
It is not taxable.
No, that is not the reason. See, when a company will go into the liquidation, this is a shareholder who is holding the shares in this company. Now, this company goes for a liquidation. So, there is the extinguishment of rights, or this extinguishment of shares for the shareholder, and that is the reason why the company is compensating him through the asset or the cash. So this is the compensation for the extinguishment of rights. So in the first case, when the company is transferring the assets to the shareholder, this is a capital gain. But this is exempt by virtue of 46(1). So this is the transfer by the company, but this is exempt under 46(1). Isn't it? However, there is also a transfer by the shareholder because he is extinguishing his rights in the shares. His shares are getting extinguished. So when there is extinguishment of an asset, there is a transfer. So here there is a transfer in the hands of shareholder under 247. And that is the reason why there is taxability in the hands of the shareholder. So there is taxability in the hands of the company, but this is specifically exempt under 46(1). But in the hands of the shareholder, there is also a taxability because he is extinguishing his shares are getting extinguished. So there is also a taxability in the hands of the shareholder. Are we clear about this? Yes or no?
Clear, ma'am.
Yes? Any doubt? Okay. Now, what will happen? Let's say, for example, my cost of acquisition. What will be the cost of acquisition? See, FVC you have understood. The FMV of the shares as on the date of distribution minus the deemed dividend. Cost of acquisition will be what? What will be my cost of acquisition, students?
Amount recorded in the books, ma'am.
No, not amount recorded in the books. First of all, you tell me what is which assets cost you are looking into here. Which assets cost we will consider over here.
Ma'am, the shares which the shareholders has given to the company.
Yes. So here we are considering the cost of the shares. And what is the cost of the shares over here? The actual cost, isn't it? So here if we look at it, the cost of acquisition for the shareholders will be the cost of the shares. So whatever actual cost that they would have paid to acquire the shares, that will be the cost. Because what is the asset transferred by the shareholder? The asset transferred by the shareholders are the shares. Isn't it? So here my asset transferred is shares, which are extinguished. Here the asset transferred was the assets distributed by the company. Are we getting it? So here the cost of acquisition will be my cost of shares. What will be my period of holding? Till what date I will consider the period of holding? Till the date of commencement of liquidation. Till the date of commencement of the liquidation. Now, what if the asset received under liquidation is transferred by the shareholder? So let's say I've received, let's say, a plant and machinery. Now that is being transferred by me. So my FVC will be my actual sale consideration. Isn't it? What will be my cost of acquisition in that case? What will be my cost? Yes. Yes, students, please faster. What will be my cost? See, the cost here will be the FMV, right, which is already taxed. So if you see here, the cost will be the FMV taxed under section 46(2). So you will allow this to me as a cost. Technically, I haven't paid any cost for these assets which I have received. So whatever amount is taxed will be cost for, right? Now, period of holding. The period of holding is defined under which section? 242A. Let's look at 242A. What does 242A says? In determining the period for which any capital asset is held by the assessee, in the case of share held in a company in liquidation, there shall be excluded the period subsequent to the date on which the company goes into liquidation. So if you see here, the period of holding I have considered till the date of commencement of liquidation, right? This is talking about the asset which is received on liquidation. This is talking about the shares which are held by the company on liquidation. So they are saying you will exclude the period after the company goes into liquidation. What about the other assets that the company has given me and now that I'm selling them? So if you see the clause B, which says in the case of a capital asset, which becomes the property of the assessee in the circumstances mentioned in 49(1), there shall be included the period for which the asset was held by the previous owner referred to in the said circumstances. Now, what is section 49(1)? Let's go to section 49(1). This is my section 49(1). Here, whether liquidation is covered, it says where the capital asset becomes the property of the assessee, whether here the case of liquidation is covered. Just go through the section, whatever is there on the screen, and tell me whether liquidation is covered over here. Yes, it is covered. If you see the clause 3C on any distribution of assets on the liquidation of a company. So, under section 49(1), the liquidation by a company is covered. And what does 242A says? 242A was telling me that in case the property became the property of the assessee, let's go back to 242A. It says in the case of a capital asset which becomes the property of the assessee in the circumstances mentioned under 49(1), there shall be included the period for which the asset was held by the previous owner referred to in the said section. What does this mean, students? By any chance, if you know, what will this mean? You have done this as a part of your IPCC also. Yes, look into it and tell me what does it mean. Yes. What does this mean?
Ma'am, here I think it means that we should consider the period for which the previous owner, that is the firm which is goes into liquidation, which has the asset, uh, the time period of asset, uh, that time period for which the firm has this asset, we should consider.
Yes, absolutely. So this means that you include the period of holding of the company which has held these assets. So you have to club the period of holding of the company along with the period of holding till the time that you are holding the asset. Are we getting it? So whatever time the company has held the asset, that has to be clubbed in your period of holding. So this is what the explanation 1 to section 242A provides. Are we clear? So the period of holding will be clubbed. So my cost of acquisition will be the FMV taxed under 46.2. Now you will tell me 49.1 is saying that the cost should be the cost which is incurred by the previous owner. So actually the cost should be what? The cost at which the company has purchased the asset. But if you read section 55, which is a specific section, it says where the capital asset become the property of the assessee on the distribution of the capital assets of a company on its liquidation, and the assessee has been assessed to income tax under the head capital gain in respect of that asset under 46. The cost means the fair market value of the asset on the date of distribution. So there's a specific section 55 which says that the cost shall be the fair market value which is taxed under 46.2. But for the period of holding, you will club the period of holding of the company also. Are we clear about this point? Shall we solve a question on this so that it becomes clear for all of you? Yes or no? Any doubts so far? Any questions? Any doubt? Okay, let's solve a question. Okay. ABC Limited went into liquidation on 1st June 2024. Let's write down. ABC Limited went into liquidation on 1st June 2024. On that date, the company possessed the following funds. One second, let me just, I think there's some screen which is, sorry. Just give me a second, I think my screen has just hanged up. Is the screen visible to you? Okay. I think there's some error just coming. Okay, yes. So the ABC company went into liquidation and it possessed the following assets. You can write following funds. So first is the share capital and second will be your reserves and surplus. So share capital and my reserves. Now what is the amount of my share capital? You can write down 100. My share capital will be, let's say, 100. And reserves, or you can just write down, let's say, share capital 5 lakh. Let's not make it 100. Let's make it 5 lakh. And reserves, we can write down 3 lakh. Then excess realization on the liquidation or in the course of liquidation. Excess realization in the course of liquidation, let's say 5 lakh. So this becomes 13 lakh, isn't it? Now, there are 5 shareholders who received 2.6 lakh in settlement. In settlement, they received the 2.6 lakh. So yes, how will you calculate the capital gain? First of all, tell me for the company. What will be the capital gain for the company?
Ma'am, here no capital gain for the company as it is not considered transfer for the company, it is distributed.
Yes. So 46(1) specifically says not taxable in the hands of company. So for company, this is not taxable under section 46(1). What about in the hands of the shareholders? Yes, in the hands of shareholder, what will happen? Faster, please. What will happen in the hands of shareholder?
Ma'am, in the hands of shareholders, 8 lakh will be taxable as capital gain.
8 lakh. Okay. First of all, what will be the deemed dividend? How will it distribute between the two heads of income? How much will be deemed dividend? So in the hands of shareholder, there will be two instances, as I told you. One will be my deemed dividend and one will be capital gain under section 46(2). So what is the amount of deemed dividend?
I have not considered, I forgot it.
So deemed dividend will be 3 lakh divided by 5 shareholders. So 60,000 in the hands of each shareholder, right? Then I have received 2.6 lakh, right? 2.6 lakh in settlement we have received. So each shareholder has got 2.6 lakh. Out of this, we will reduce minus this deemed dividend 60,000. So this makes it 2 lakhs. Okay, then my cost of acquisition will be what? What will be my cost of acquisition?
Actual cost.
Yes, actual cost, but what is that? What is my actual cost? Yes, students, come on faster. It's not that difficult. Very simple question. What will be my actual cost? Yes. 5 lakh divided by 5, right? The share capital is worth 5 lakh. It is not given that I have paid any excess amount over that. So we'll consider 5 lakh divided by 5, which is 1 lakh. So my capital gain shall be 1 lakh. Here there is no information given about the period of holding and all of that. So we'll consider here just that this is the capital gain. Are we clear? So this is a short example that I wanted you to understand how it will be taxable. Let's do one more example. ABC Limited has gone into liquidation. ABC Limited has gone into liquidation. And the balance sheet before liquidation was as follows. So this is my balance sheet as on 1 June 2024. On my liability sides, I have share capital since 2013, 5 share capital since 2013. How much? 5 lakh. Then I have my reserves and surplus, accumulated profit 3 lakh. Or you can write down general reserve 3 lakh. Then revaluation reserve 2 lakh. My revaluation reserve is 2 lakh. Capital asset is of 10 lakh. I have one capital asset of 10 lakh. This was acquired in the year 2013. Now there are 5 shareholders and the capital asset is distributed proportionately. Mr. A, one of the shareholder, sold his share in the capital asset, sold his share in the capital asset for rupees 3 lakh on 1 November 2024. Since it was a Diwali day, he sold the capital asset. Okay. So, what will be the implication under 46(1), 46(2)? Yes. First, for the company, what will be the taxability? Not taxable for the company? Yes. Under 46(1), there is no taxability. That is right. What will happen in the hands of the shareholder? This is not a transfer under section 46(1). What about in the hands of the shareholder? Yes. Deemed dividend will be there. Yes. My deemed dividend is how much? How much is my accumulated profit? 3 lakh divided by 5, so 60,000. Deemed dividend under 222C. And what will be my capital gain under section 46(2)? My full value of consideration is how much? 10 lakh is distributed amongst all the shareholders. Yes. So then how much will be my FVC here? It will be 2 lakh minus 60,000. 1.4 lakh. Isn't it? Yes, right. Minus my cost of acquisition will be how much? What shall be my cost of acquisition? 1 lakh. Correct. So cost of acquisition will be 1 lakh. So 40,000. Yes, it's a long-term, short-term gain. It's a long-term or short-term? This is a long-term. Yes. So this is a long-term capital gain of 40,000 since it is held since 2013. Now, when the capital asset is sold by the shareholder, how will you compute the capital gain? So my full value of consideration is 3 lakh. What will be my cost of acquisition? What will be my cost of acquisition? Yes, 1.4 lakh. right? So my cost of acquisition will be 1.4 lakh. This will become my cost, right? Whether it will be long term or short term, whether it will be a long term capital gain or whether it will be a short term capital. Short term or long term? Think about it. Go back to your charts again and think about it, whether it is a long term or whether it is the short term. It is long term, yes. Why is it long term?
Ma'am, as it is also includes the period of holding of the company. That's why, and we have considered the cost of acquisition uh, uh, of that also. That's why it is long term, not short term.
Yes, absolutely. So it will include the period of holding of the company also, and therefore it will be a long-term capital gain. Okay, so this will be my long-term capital gain. It will include the period of holding of the company also under section 242A. Yes, are we clear about the liquidation? Yes or no? Any questions so far? Any doubts? Yes. Can you just go through the provision once again and see if you have any questions? I'm just giving you 1 minute time. Yes. This is again a past exam question that we have just now discussed. So I want you to just go through it for 1 minute. Yes. Do you want to solve one more question on this? Okay. Or is this clear? Yes, ma'am. Thank you so much, Oja. Okay. Let's then proceed to the next section if this is very clear. Section 46A, buyback of shares. Now here, there is an amendment which has been introduced this particular year. So we'll see what the amendment is. Okay. Case of buyback of shares. What is buyback? What is buyback?
Ma'am, buyback is the process where the company buy its own shares from the shareholders or from the market.
Correct. So see, what used to happen is earlier in the buyback of shares, when the company buys back its own shares, so giving up the consideration to the shareholders. See, company can give the consideration to the shareholders in terms of the value through dividends, or it can just buy back its shares and pay them the amount. Now, when the company buy back the shares, there is extinguishment of right, there is extinguishment of shares in the hands of the shareholder. The company, when it buys back the shares, it has to destroy those shares. It cannot reissue those shares, right? So there is the extinguishment of shares, there is extinguishment of the shareholders' right. So this is the transfer under 247. So buyback of shares is considered as transfer under section 247, as there is extinguishment of shares, isn't it? So till last year, or rather I would put a date, effective date before 1st October 2024, the buyback tax was applicable. There was a buyback tax which was applicable in the hands of the company undertaking the buyback. So until last year, there was a buyback tax which used to be levied in the hands of the company which is undertaking the buyback. So although there is a capital gain in the hands of the shareholder, but the liability to pay the tax was shifted on the company undertaking the buyback. So there was a buyback tax under section 115QA. Are we clear? This was in the case of the buyback of shares. In the case of buyback of shares by the domestic company. So you can just write down prior to 1st October 2024. There used to be two things which used to take place. The buyback of shares by the domestic company was taxable, or there used to be buyback tax in the hands of, sorry, in the hands of the company. Are we clear? There used to be a buyback tax in the hands of the company under section 115QA, which was at the rate of 20% plus surcharge of 12% plus 4% cess, which effectively makes it to 23.296%. Which effectively makes it to 23.296%. This is number one. Then secondly, in case of buyback of shares by other company, there used to be the taxability in the hands of shareholder under section 46. Now, what do we mean by domestic company, first of all? What is a domestic company, or which company is a domestic company?
Ma'am, domestic company is a company which is incorporated in India.
Is it just only that? Go back to your basic concepts class. Have you discussed about the definition of domestic company there? Yes. Let me take you to the definition of domestic company. Have you not done the domestic company definition in the basic concepts class, or have you done it? Yes or no? A domestic company means an Indian company. Domestic company means an Indian company or any other company which, in respect of its income liable to tax under this act, has made the prescribed arrangements for the declaration and payment of the dividends within India. So domestic company not only means a company incorporated in India, it also includes even a foreign company which has made the arrangements for the declaration and payment of dividends within India. So when it pays the dividends in India, it maintains the registers in India. That is when the foreign company can also be regarded as the domestic company. It's not necessarily that only an Indian incorporated company is the domestic company. Are you getting that? So it could include both. Yes or no? So domestic company not only means only the Indian company, but it could also include the other kind of company, which is a foreign company, if it has made the arrangements for the declaration and payment of dividend in India. Are we clear about that? So, what do we mean by declaration of or made the arrangements for the declaration and payment of dividend? It has maintained a share register at the principal place of business in India. The general meeting for declaring the dividend is held in India. So that means that the company has made the arrangements to declare the dividend in India. So that is the meaning of a domestic company. Are we clear? So for the domestic company, if it buys back the shares, there will be the buyback tax. And for the other company could include a foreign company buying back its shares. Then the taxability will be in the hands of the shareholder under 46A. Under 46A. Now, under 46A, what will be my computation? Under 46A, the computation used to be that the value, the difference between the value of the consideration which is received on the buyback minus the cost of acquisition. Are we clear? So here, my taxability used to be the consideration received minus the cost of acquisition of the shares. This used to be my capital. Now, what is happening post 1st October 24? Now, post 1st October 24, in case of the buyback of shares by a domestic company, the sum paid by the domestic company would be not considered as capital gain, would be considered as dividend and chargeable under the head income from other sources in the hands of the shareholder. Supposed 1st October 2024, buyback tax will not be there, and in the case of buyback of shares by the domestic company, there will be the consideration on buyback would be considered as dividend taxable in the hands of the shareholder, which is chargeable under the head income from other sources. So there will be no buyback tax. Post 1st October 2024, there will not be any buyback tax. Are we clear about this? So in case of the buyback of shares by the domestic company, prior to, if the question is now giving you that the buyback is done prior to October 2024, then in that particular case, it will be considered as the buyback tax will be levied in the hands of the domestic company. However, post October 2021, October 2024, the taxability will be in the hands of the shareholder. Are we clear? And the major point here will be that no deduction for expenses would be available in respect of that dividend. So they will not get any deduction of the expenses. So here, no expenses allowed. So the entire consideration which was considered as my capital gain, which was earlier considered under the buyback tax, but under the buyback tax also, the amount charged to buyback tax was the consideration minus the cost. Under the buyback tax also, this was considered to be the consideration minus the cost. However, now the entire consideration will be considered as my dividend. The entire consideration will now be considered as dividend. And as per section 46A, the value of consideration now on the buyback of shares by a domestic company would be nil, and the difference between the cost of acquisition and the value of consideration received by the shareholder will therefore result in a result in a capital loss. Are we getting that? So what is now happening under the buyback is that my consideration is chargeable under the head dividend, and under section 46A. 46A, you can claim the cost of acquisition of shares as the capital, which can then be set off and carry forward as per the capital losses. So if it's a short-term capital loss, it can be set off against short-term capital gain and long-term capital gain. But if it's a long-term capital loss, you can only set it off against the long-term capital gain, and you can carry it forward for a period of 8 years. So earlier, this consideration received minus my cost of shares If it was the domestic company, this was leviable to buyback tax. If it was other company, this was under section 46A. But now, post, this is prior to 1/10/24. But post 1/10/24, now what will happen is my consideration which is received, this will be dividend, and the cost which is there, this will be under section 46A. So are you getting the two aspects? So the consideration will be charged under the dividend, and the cost which is there, you can set it off as a capital loss. Yes or no? Are we clear about this? Any questions so far? Any doubt? Any question? Yes or no? Okay. So if there are no questions and no doubts, we can take a break for 10 minutes over here. Let's take a break. respect to 46A. So see, effectively, students, what is going to happen with 46A is that you will be charged to tax on the amount of consideration that you receive, but you will get the cost which is there as the set off of losses only when you will earn capital gain in future from other assets. So what is happening on the sale consideration, on the consideration received to you for the buyback, you're paying tax now. But the cost will be allowed to you as deduction because it is now considered as a short-term or long-term capital loss. It will be allowed to you as a deduction only against the long-term or short-term capital gain from any other assets in the future. Clear? Oja, you had some doubt?
Ma'am, I just want to ask the cost of acquisition you have mentioned in 46A. It is यानी कि वही कॉस्ट ऑफ एक्विजिशन है ना जो कि बायबैक के दौरान कंपनी शेयर होल्डर्स को पे करेगी कंसिडरेशन.
No. The cost is the cost of shares. तो पहले क्या हो रहा था? पहले मेरा sale consideration minus cost was considered as taxable on under the buyback tax. But now sale consideration is dividend, cost is a capital loss. So they've divided into two. Earlier, cost of shares was allowed to me as deduction in front of the sale consideration which is taxable. अब ऐसा नहीं होगा. अब sale consideration dividend, cost of shares is my long-term capital or short-term capital loss. Are we clear?
बट मैम ये जो 46 के अंदर जो कॉस्ट ऑफ एक्विजिशन है ये यानी कंपनी के तो खुद के ही शेयर्स है ना तो उसके लिए कॉस्ट ऑफ एक्विजिशन क्या होगा यानी.
No. See, it is not like this. This is not a tax in the hands of company.
Yes, ma'am.
Buyback tax किसके हाथ में tax है? Buyback tax is the tax or the taxation on the buyback is the tax because the shareholders shares are getting extinguished.
Yes, ma'am.
So transfer किसके हाथ में हो रहा है? Shareholder.
Shareholders के.
Whose liability it is? Shareholder. But पहले क्या हो रहा था? Just like dividend, the taxability was shifted or the liability to discharge the tax was shifted in the hands of the company doing the buyback. Just like the dividend it was, right? जब dividend distribution tax था. Now what they have done is they are saying that the liability will remain in the hands of the person whose income it is, who is the shareholder. But now it will be considered as dividend under 222F and the cost of the share because actually तो ये capital gain ही है because there is extinguishment of shares. So your cost used to be a cost of shares that you have paid to acquire the shares. अब वो cost capital loss हो जाएगा. So consideration is dividend. Cost of acquiring the shares is your capital loss.
Okay, ma'am.
Are we clear?
Clear, ma'am. Thank you.
Okay. Yeah. Any other question? Any other doubt, students? Yes or no? Fine. So let's proceed further. Now what we are going to do is, see, we are done with 45, we are done with 46. Now I'm moving to 47. Section 47 is transactions not regarded as transfer. Transactions not regarded as transfer. This is provided in section 47. So let's see what are the transactions not regarded as transfer under 47. Nothing contained in section 45 shall apply to the following transfers. So meaning 45 will not apply to these transfers. Any distribution of capital assets on the total or partial partition of HUF. So when the HUF is dissolved by way of partition, whether it's total or partial, and the capital assets are distributed to the co-partners. This is not regarded as transfer by HUF to the co-partners. So therefore, there will not be any tax implication. So just write down over here, number 1, distribution, or you can just write like this, HUF is distributing of assets on the total or partial partition, the co-partners. This is not a transfer under section 47. So that is number 1. Okay. Let's go to the B point. Any transfer of a capital asset under a gift or will or an irrevocable trust. Now, if you see, here it is mentioned, the following clause 3 shall be substituted with effect from 1/4/2025. So this has been amended for your attempt. So prior to amendment, this used to be any transfer of a capital asset under a gift or will or an irrevocable trust. But now it reads as any transfer of a capital asset by an individual or HUF under a gift or will or an irrevocable trust. So can you please tell me what is the difference prior to amendment and what is the difference after the amendment with an example? The act extracts are not visible. Yes, Ginny, yes, you can. You are raising the hand. You have question.
Yes, ma'am. Ma'am, you have read the section 47. Is it section 47 or 247?
47.
Okay.
Is it visible now?
Yes, ma'am,
Okay.
act is visible.
Yeah. So now tell me, what is the difference between any transfer of a capital asset under the gift or will or an irrevocable trust prior to amendment and post amendment which is given? Yes. What is the difference that you are able to see?
Ma'am, earlier there was no individual and Hindu undivided family were there, but now they were added.
Yes, absolutely. So what difference does it make? So prior to amendment, what will be the result that individual or HUF was absent?
Before amendment, um, 47 class 3 applicable for all assessees. After
Yes,
amendment, only applicable for individual HUF assessees.
absolutely. So see, prior to amendment, even the gifts by company, by partnership firm, by AOPs were also not regarded as transfer. But post amendment, they have specifically made this as only applicable to the gifts by individual or HUF. Because any which ways, a company cannot create a will, right? And will is only by individual. So therefore, now they have said it that transfer of capital asset by individual or the HUF under gift, will, or through the irrevocable trust. This is not a transfer under section 247. Yes, are we clear about this? Okay. Now see students, I'm not covering the rest of the 47 over here. I will cover it at the right time, but for this moment, we are not covering. Okay. Now, first we will speak about this transfer of capital asset under a gift or will or an irrevocable trust. Now here, as you saw that this is only now being applicable to individual or HUF. Okay. Now directly, before moving on to the rest of the section 47, there is also a section that I first want to discuss on this particular point, which is my section 49. Now, what is this section 49? So what section 49 says is cost with reference to certain modes of acquisition. 49 talks about what is the cost. It says where the capital asset became the property of the assessee on any distribution of assets on the total or partial partition of a HUF under a gift or will. These are the two instances that I have covered till now. Total partial partition and under the gift or will. What will be my cost? The cost of acquisition of the asset that I am getting in the gift or will, shall be deemed to be the cost for which the previous owner of the property acquired it, as increased by the cost of improvement of the assets incurred or borne by the previous owner or the assessee, as the case may be. So what they are trying to say over here is that in case the asset is acquired under the gift, will, irrevocable trust or total or partial partition of HUF. So in these cases, when I will sell this asset, so when the assessee will sell these assets which are acquired under the partition or through the gift or through the will or through the irrevocable trust, then what will be the cost of these assets? Because the assessee has never paid these costs. The assessee got it for free. So the cost of acquisition under section 49(1) will be my cost to the previous owner. Will be my cost to the previous owner. Are we getting this point? And what will be my period of holding? So now period of holding is defined under 242A. So let's go back to 242A. So 242A says that in determining the period for which any capital asset is held by the assessee, the explanation one is saying, in the case of a capital asset which becomes the property of the assessee in the circumstances mentioned in 49(1), there shall be included the period for which the asset was held by the previous owner. So where the property is becoming, the asset is becoming the property in the circumstances mentioned in 49(1). So gift, will, irrevocable trust total partial partition are the circumstances mentioned in 49(1). Then the period of holding will include the period of holding of the previous owner. So as per the explanation 1 to section 242(a), there will be clubbing of period of holding. The period of holding of the previous owner will be clubbed. Are we clear? Now, what about the indexation? Whether you will be allowed the indexation from the year in which the previous owner acquired it, or you will be allowed the indexation from the year in which you held the capital asset. So let's go back to now the section for indexation. Indexation is provided by section 48. Mode of computation. What does it say? Section 48 says the second proviso that where the long-term capital gain arises from the transfer of a long-term capital asset, the provisions of the clause 2 shall have the effect as if for the words cost of acquisition and the cost of any improvement, the words indexed cost of acquisition and indexed cost of improvement had respectively been substituted. So the clause 2 says that the income chargeable under the head capital gain shall be computed by deducting from the full value of consideration received or accruing as a result of transfer of a capital asset the following amount. Clause 2 says the cost of acquisition of the asset and the cost of improvement. So now the second proviso says that instead of the cost of acquisition, you will get index cost of acquisition if the asset is a long-term capital asset. Now, whether the question arises, indexation is what you will get from the year in which the previous owner held the asset or from the year when you got the asset. What do you think? Yes. From where you will get the period of holding, indexation. From the previous year in which the previous owner took the ownership. Yes, Vignesh, you are right. So, as per the ruling in Manjula Shah, it was held by Bombay High Court that the indexation will be available from the year in which the property was held by the previous owner. So you can just write down indexation is available from the previous year in which the previous owner first held the asset. This is as per Bombay High Court ruling in Manjula Shah. Yes, students, are we clear about this? Any questions so far? So the cost of the previous owner will be available to you. The period of holding will be also from the year in which the previous owner held the asset, and even the benefit of indexation will be from the year in which the previous owner held the asset. So the Bombay High Court in CIT versus Manjula Shah has clearly held that the index cost of acquisition in case of gifted asset has to be computed with reference to the previous year in which the previous owner held the asset and not the year in which I became the owner of the asset. Are we clear? So benefit of indexation will be available. Okay? Any doubt? Any questions? Any doubt? Okay. Now, here I would like to discuss one more example with you. So, you have to tell me what will be the answer for that. Okay. So, let's say for an example, if I have purchased the property on loan, let's say I have, okay. So, let's say for example, Mr. A has purchased of rupees, let's say 2 CR through loan of rupees 1.5 CR and rupees 50 lakh through own contribution. Okay. Now, Mr. A has, let's say, defaulted, or let's say, for example, let's change this. Mr. A has now sold the property for rupees 3 crores. So, Mr. A has purchased the house, let's say, for example, for 2 CR by taking a loan amount and also through some of the own contribution. Now here, how will you first compute the capital gain? So Mr. A has purchased the house. He has taken the house on mortgage. And now Mr. A repays the loan. So in installments, okay? He is repaying the loan in installments. So how will you compute the capital gain? Let's say he has repaid of rupees, let's say 75 lakh. So what will be my capital gain? Yes. What will be the capital gain, students? Faster. Very simple question. What will be my capital gain? It will be what? 3 CR, right? Minus what will be my cost? My FVC is 3 CR minus my cost of acquisition will be what? 1.5 CR. Isn't it? No, Ginny. It will be 1.5 CR plus 50 lakh, which is basically 2 CR, right? Will I get the additional deduction of the loan repayment amount? Answer is no, because I've not repaid the entire loan. I've not repaid the entire loan. So the cost for me is 2 CR only. So even though I've taken it on loan, the cost technically is 2 CR. Isn't it? That's the cost I'm paying. Even though I have not paid it entirely, but I have to give back to the bankers. I cannot, take the 3 CR and just, go underground. No, that's not possible. From the 3 CR, I have to discharge the loan obligation of 2 CR. Only then the house will be, I'll be able to sell that house. Without discharging 2 CR, I'm not going to be able to sell the house. So the cost for me will be 2 CR only. So this capital gain will be my 1 CR. Fine. But I will not get any additional deduction of the loan repayment. Fine. So the 75 lakh, I will not be able to claim it. Because I'm already claiming 2 CR. So this 75 lakh is nothing but towards the discharging the 2 CR. Let's take another instance. Let's say Mr. A has purchased the house of 2 CR through the loan of rupees 1.5 CR and rupees 50 lakh as own contribution. Now Mr. A dies and son of Mr. A, who is Mr. P, inherits the house and decides to sell it for rupees 4 CR. Right? So basically, what happens is that in this particular case, the Mr. A has already died. Right? Now, it is a son who is inheriting the property. And Mr. A had taken the loan against the property. Now, this is inherited by a son under the will. Now, for obtaining a clear title thereof, there was some outstanding loan which was appearing. So, Mr. P is paying the outstanding amount of loan. Let's say now the outstanding amount was 15 lakh. Let's say the outstanding amount was 15 lakh. Mr. P, in order to obtain clear title of house, clears the outstanding loan amount of rupees 15. Now, here my full value of consideration will be 4 CR. My cost of acquisition will be the cost to the previous owner, which is 2 CR, isn't it? Plus 15 lakh, which I have paid to clear the outstanding balance of the loan. Are you getting this point? So here, I will get the deduction of the 15 lakh rupees. This is the reason here that here I have inherited the property from my father. So yes, the cost, it will not be regarded as transfer when I am inheriting the property as per 47, right? The cost of acquisition will be the cost to the previous owner, which is, let's say, 2 CR. Now, there is an outstanding loan which is there, which I am clearing. So, there's an outstanding loan of the predecessor, which is cleared by the successor in order to obtain the clear title of the property. Otherwise, I will not be able to sell the house. So, that will be regarded as my cost of acquisition as per the Supreme Court ruling in RM Arunachalam. So Supreme Court in RM Arunachalam has held that the amount of the loan, the amount which is paid by me to clear the encumbrances, will be allowed to me as the deduction. Will be allowed to me as the deduction. So you can just write down. This is the amount paid by assessee to clear the encumbrances will be allowed as deduction as per the Supreme Court ruling in RM Arunachalam case. So this is my cost to the previous owner under section 49(1) plus the amount repaid by me as the loan to clear the encumbrances will be allowed as a deduction. My period of holding will include the period of holding of the previous owner. So there will be clubbing of period of holding of previous owner. And indexation will also be available from the year my father held the asset. This is as per Bombay High Court in Manjula Shah. Are we getting that? Now you will see, ma'am, in the earlier example, why you didn't allow us the loan repayment amount. So when you are paying the loan repayment to clear the title of the property, that is something you are paying towards the cost of the property. That is not something, an additional amount that you are paying. So this will not be allowed as deduction. If the loan is repaid by the assessee himself, as he has only taken that loan, then it will not be allowed as deduction. But if the loan was taken by somebody else, and now I want to get a free title of the property and I am paying that loan amount, then only it will be allowed as deduction. So here you can write down, if loan is repaid by assessee who has taken the loan, the same is already considered as part of the cost. So no further deduction Yes, students, any question, any doubt? Did you get this example? Yes. Yes, Ginny.
Ma'am, in this second example, the 15 lakh is a excess payment or the outstanding loan, because in the question it is written that it is outstanding loan which is paid by the successor.
Yeah.
Now, then why we added it 15 lakh, because it is a part of 2 crore, na?
Yes. See, why we are adding this? Because this is not my obligation.
Yes, ma'am.
I am inheriting it. So in order to clear the title of the property, I have to pay this amount. So this becomes my cost. Otherwise, this was never my obligation per se.
Okay.
But cost to the previous owner was 2 CR only. So therefore, we have taken that cost.
That's this 15 lakh is excess of these 2 crores.
Correct. Correct.
Okay, ma'am. Now clear. Thank you.
Okay. Any other question, students? Any doubt? Are we clear about this? 47. See, this is how you have to correlate and study. You cannot, just do one thing and then, ignore the rest completely. So you have to correlate the entire DT and then study it. There could be a lot of examples that you have in the PGBP where capital gain also, because the will be there. Because the question which will come in the examination, students, is going to be a full-fledged question where your entire concepts would be tested. So if you're very clear with your concepts, if you're very clear in terms of your understanding of the law, you will not face any problem. So first of all, make your base as much clearer as possible. Try to understand in depth whatever I'm saying during the class, whatever notes that I'm giving you throughout the class. I want you to write it down. Because students, what will happen is, the moment you start practicing, see, we do not have any practice after our IPCC exam. So we lose that touch. So that becomes a very, very problematic thing, that you are not able to reproduce the language which is required. Once you clear your examination, you'll be a qualified CA. So we are not expecting anything less from you as compared to what a CA would have an understanding. It's just, a difference between you and a qualified CA is just this exam that you're going to clear now. So you're going to be like a full-fledged doctor. So you are not, supposed to write something which is a normal language. You have to write the provisions of the law in the way it is. You should have that kind of understanding. Only then you are, qualified to pass that examination. Otherwise, why would the examiner, just pass you on whatever you are writing? Because once you pass out, there will be more higher expectations from you. So be very clear in terms of what wordings are you using. Be very clear in what you are writing. When the word is, let's say, for example, a company, you have to write a company. You cannot write an associate. You cannot write a firm. When you are, doing any kind of computational provisions, you will write assessee. But let's say when you go to the appeals chapter, you will say that it's appellant and not assessee, because then the assessee becomes appellant. So these kinds of mistakes you cannot even make into the real life. So examination is something that is preparing you for that. So be very clear about what you are writing, the way you will practice it. That's how the more idea you will have as to how you have to write in the exam. So we are going to have a full-fledged lecture on this particular problem solving, where I'm going to take you through all the problems that till now we had discussion. So I want you to be very, very attentive there. The moment you will revise this everything properly, the moment you will consolidate everything this properly, then you will be able to solve the questions. Okay. So let's proceed further. Thank you so much, Ginny. So let's proceed further. And now, see, as I said, 47, I will park it here. I'm not going to now discuss one by one what it is written in 47. Because then otherwise we'll miss on the links that I want to create for you. Okay. So what I want you to do is, now we will understand certain instruments wise, we will understand the capital gain implication. Now, instrument meaning, I'm going to talk about the debentures, I'm going to talk about the rights issue, I'm going to talk about the bonus issues, the preference shares, all of that. So right now, this is the first section that we have so far completed for you, which is section 45, 46, 46A. I have completed, and then some portion of 47. So this, we call this as a first section, as the basic concepts of section of the capital B. The second section that I am going to now touch upon in the next 40 minutes that we are left with is going to be the capital gain on different instruments. So let's start with it. Okay. So first is what I'm going to touch upon is the debentures. Are debentures a capital asset? Yes or no? Debentures are capital asset or not? What is a capital asset, students? Back to basics, 214. Does it exclude debentures by any chance? Yes. Are debentures the capital asset or not? Very simple question to you. Yes, debentures are capital assets because there's no exclusion for them. It's property of any kind. Capital asset under 214 is nothing but the property of every kind, isn't it? So yes, debentures are indeed a capital asset. So now I'm not going to talk specifically that when you sell the debentures or what will happen. So it's about, let's say I have the debentures in a company. Now, these are, let's say, compulsorily convertible debentures. So there are different kind of debentures a company would generally issue. Some are non-convertible debentures. Some are compulsorily convertible debentures. Some are optionally convertible debentures, depending on the different rights the company want to give to a shareholder. These debentures are granted. See, when you are into the mergers and acquisition, and when somebody is trying to acquire a business or invest in your business, these are the business considerations which both the buyer and the seller company will do as to what we would get it in return. Do we want literally an equity stage at this moment? Because equity comes with its risk, both for buyer and the seller. For the seller, the risk is that if it gives the equity to somebody else, it may be a possibility that the other person may just usurp the entire holding, may become the principal holder of the shares, and may just kick you out of the business also. So you have to be careful as to what you are doing. So these are the principal considerations when you do a mergers and acquisitions in the real life. So sometimes the companies, instead of giving the equities at this stage, they will give the CCDs or will give the OCDs. CCDs are compulsorily convertible debentures. OCDs are optionally convertible debentures. If later on the other party wants to exercise the option, they can move to equity. So let's say I'm talking now about the compulsorily convertible debentures, which can get converted to equity. So on the conversion, the shareholder or the debenture holder will get the equity in return of the debentures which will get expired. Now, if this conversion of debentures into equity, so you are a debenture holder, you are getting the equity in return of debentures on the conversion, on the expiry of the period, on the maturity of the debentures. Will this be a transfer under 247? Yes, will this be a transfer under 247? What does 247 says? Transfer includes sale, exchange, relinquishment, extinguishment. Is this a transfer? Yes, this is a transfer. You are getting one in the exchange of another, right? So this is a transfer. But let's see what section 47 says. So if you go to section 47, section 47 says that this will specifically not be regarded as the transfer. So let me show you the particular clause. One second. Again, my screen stopped. Give me a minute. Yeah. Are you able to see the screen? Yes or no? Okay. So if you see, 1 second. Yeah. So 4710, what does it say? Any transfer by way of conversion of bonds or debenture stock or deposit certificate in any form of a company into shares or debentures of that company will not be regarded as transfer. So 47 is what? 47 is transactions not regarded as transfer. And 4710 is specifically telling me that conversion of debentures into the equity shares is not to be regarded as transfer. So this is, though under 247 this may be a transfer, but section 47 says this is not a transfer. So this is specifically exempted from the transfer by way of section 247. Section 47. So this is not regarded as transfer under 47. Now what will be, let's say for example, you have acquired the equity shares when the debentures were converted. So now what will be the cost of these equity shares? So what will be now cost of the equity shares? Let's say for example, now I want to sell these equity shares. What will be my cost? Notes are not visible. 1 second. Yes, now is it visible?
Yes, ma'am.
Okay. So now what will be the cost of my equity shares? So since this is not regarded as transfer, we have to make reference to determine the cost under section 49. Right? So let's go to 49. 49 2A says where the capital asset being a share or debenture of a company. So debenture in conversion of a debenture. So if you receive a debenture in conversion of debenture, it is talking about that debenture. So where the capital asset being a share became the property of assessee in consideration of a transfer referred to in 4710 or 10A. What was 4710? The conversion of debentures into equity shares is not regarded as transfer. The cost of acquisition of the asset, the cost of the equity share to the assessee shall be deemed to be the part of the cost of debenture. So therefore, the cost of the equity share will be the cost that you paid to acquire the debenture. So therefore, the cost of equity shares will be the cost paid to acquire the debentures. This is section 49. Are we clear? So when you will sell the equity shares in future, the cost will be the cost of debentures. So let's say I've paid 100 to acquire debentures. Now the debentures are being converted to equity. So the cost of equity share will be 100. Now what would be the period of holding of the equity shares? What will be my period of holding for equity shares? This will include the period of holding of debentures. This will include the period of holding of debentures. So let's say I've acquired the debentures in 2005. These are converted into equity in 2007. So the period of holding will not be from 2007. The period of holding will be from 2005. Are we clear? So when the debentures are converted into equity, first of all, this is not regarded as transfer. Secondly, the cost of acquisition of equity shares will be the cost of the debentures, and the period of holding of the equity shares will include the period of holding of the debentures. Are we clear? Any questions so far? Yes or no? Clear? Second instrument is, let's say when preference shares are converted to equity. So again, just like debentures, we have convertible preference shares. So again, whether this will be regarded as transfer, let's go back to 47. 47 says what? Whether preference shares are to be regarded as the, the conversion of preference shares is to be regarded as the transfer. So what does 47 says? So 47 says again the same thing. So 47 says any transfer by way of conversion of preference shares of a company into equity shares of that company is not going to be regarded as transfer. So this is not a transfer under section 47. Are we clear? This is 47(10)(b). So you don't have to remember the clauses also here. You can just remember 47. You cannot remember 47(10) or 10(b). That's fine. What will be my cost of equity? So again, section 49(1) says, 49(2)(a) says, the cost of the preference shares will be my cost of the. Are we clear? So, in case of 49(10)(b, again, 49 again says the same thing. So, if I take you to section 49, it says, if you see here about the preference shares, it says that the cost of the preference shares will be nothing but the cost of the, cost of the equity shares will be the cost of the preference shares. Are we clear? So 49(2)(a) says where the capital asset being the equity share become the property in consideration of a transfer referred to in 47(10)(b, the cost of the acquisition of equity shall be deemed to be the part of the cost of preference share. So 49(2)(a)(e). Just change here. Fine. Now, period of holding of the equity share again shall include the period of holding of preference shares. This is as per explanation 1, section 242A. Clear? So this is also same as debentures. Yes or no? Any doubt? Any question till now? I think this is very, very clear. Yes. Now, what about the redemption of the preference shares or debentures? What about redemption of preference shares or debentures? What do we mean by redemption of preference shares? What is the redemption meaning? What is the meaning of redemption? Past. Redemption meaning that these are the amounts are given. These are just now the tenure is completed and these are redeemed or matured. So redemption of preference shares or debentures will be regarded as the transfer. There is no specific exemption for that under 47. So this will be regarded as transfer. Because the shares will get over, the maturity of the shares will get over, will be an extinguishment or relinquishment in that sense. So therefore, redemption of preference shares or debentures will be regarded as transfer. What about reduction of the share capital? What is the difference between reduction of share capital and the buyback? In the buyback, the company is buying back the shares. It is taking back the shares from the market. In reduction of share capital, the company will cancel its shares or will reduce the face value of the shares. When the company is usually a loss-making company, in order to convert its losses, what it does is it reduces the face value of the shares or it will cancel its shares. So reduction of share capital is regarded as transfer under 247 because again, when the company will reduce the face value or will cancel the shares, there will be an extinguishment of your rights as a shareholder. So this will be regarded as a transfer under 247. There is no specific exemption for that. Are we clear? Yes or no? Any questions so far? Fine. Okay. Now, what about the rights issue? Rights issue, in that case, what happens? So you see generally that the companies do these right issue. So in the rights issue, what happens is the company gives you right to subscribe to additional share. So first you get a right to subscribe the additional shares, right? So in the right issue, you get a right to subscribe to the additional shares. Now, either you have an option. You can just renounce that right, or secondly, what you can do is you can subscribe to the shares. Now, what if I renounce the rights to some other person? I don't want to subscribe it, so I'm giving it to my friend. I've got the rights. I don't want to exercise these rights. I'm giving it to some another person. So when I renounce the right in favor of another person, will there be a transfer under 247? Will there be a transfer under 247? Yes or no? So when the rights are renounced, yes, you're transferring the rights in favor of somebody else for a consideration. So this will be transfer under 247. So when the rights are renounced, there is a transfer taking place. There is a sale of those rights because you are taking a consideration from the other person, right? So my FVC will be the sale consideration, which is the actual amount that I have received or realized to sell these rights. What will be my cost of acquisition? What will be my cost of acquisition? So when you're getting these rights to subscribe. Have you paid any technically cost for that? Have you paid any cost for that? Yes or no? Yes. So when I get these rights to subscribe to shares, I have not paid any cost. The cost that I have paid is to purchase the original shares. These are not bonus shares. These are rights share where I'm getting to right to subscribe to additional shares by paying the price of those shares. It's not coming free of cost. So here I have not paid any cost as such at this moment. So therefore, the cost in that particular case shall be considered as nil. Are we getting that? So let's see section 55. Section 55 is the meaning of the cost. What it says, for the purposes of section 48 and section 49, where in the case where by virtue of holding a capital asset, being a share or any other security within the meaning of 2H of SCRA, the assessee becomes entitled to subscribe to any additional financial asset. Then, subject to the provisions of subsection 1, subclauses 1 and 2 of clause B, in relation to the original financial asset on the basis of which the assessee becomes entitled to any additional financial asset, means the amount actually paid for acquiring the original financial asset. This is not our case. Here we are talking about renouncing the rights. I am not being allotted any other additional financial asset at this moment. In relation to any right to renounce the said entitlement to subscribe to the financial asset, when such right is renounced by the assessee in favor of any person, shall be taken to be nil in case of such assessee. So therefore, my cost of acquisition over here will be nil. Section 55. What will be my period of holding? Because then only I will get to know whether it's a long-term or short-term capital gain, isn't it? So period of holding will be what? Yes, this you have to give me the answer at least. What will be my period of holding? Till what point in time I will consider my period of holding? Faster. So 242A, explanation 1, talks about the period of holding. It says, in the case of a capital asset, being the right to subscribe to an financial asset, which is renounced in favor of any other person, the period shall be reckoned from the date of offer of such right. You will consider the period of holding. So period of holding will be from the date of offer of such right till the date of sale. Yes, is this clear? Now, second instance will be I'm not renouncing, but I'm subscribing to the right. I'm not renouncing the right. I'm now subscribing to the right. Now, when I subscribe to the right, what will be the cost? The cost will be the amount actually paid. Then there is no transfer. When I'm subscribing, I'm just taking the asset. But when I will sell this particular rights share, the cost for me will be the amount actually paid. And what will be my period of holding? So, in case of a capital asset being a share, subscribed to by the assessee on the basis of his right to subscribe to such financial asset, or subscribed to by the person in whose favor of the assessee, in whose favor the assessee has renounced the right to subscribe to such financial asset. The period shall be reckoned from the date of allotment of such financial asset. So the period of holding will be from the date of allotment of shares and not from the date of offer of the right. Because here you are now going to sell the rights share which you have got by subscribing to them. So we'll consider the period of holding of the rights share. That will be from the date when the rights share were allotted to you. In the case when you have renounced, you are not renouncing the rights share, you are renouncing the right to purchase those rights share. So therefore, the period of holding will be of the right that you have received to subscribe, and now you're renouncing in somebody else's favor. So the period of holding will be from the date of offer when the right was given to you till the date of renouncement. Are we clear? Yes or no? Okay. Yes or no, students? Now, let's say for example, this right that you have renounced. Let's say for example, Mr. A has got the right to subscribe. Now he is renouncing these rights, Mr. B. So what will be the cost for Mr. B of the rights share? Now Mr. B is subscribing then. He has got the share, he has got the right, now he will subscribe. So the cost of shares for Mr. B will be the price paid to A to purchase the right to subscribe plus the cost paid to company for the shares. And the period of holding for him also will be from the date of allotment of rights share. The period of holding will be from the date of allotment of rights share. Yes, this is the rights issue. Are we clear? Yes or no? Okay. Now the last one before we close the session is the bonus issue or the bonus shares. Now in the case of the bonus shares, when you get the bonus share, what will be the cost of the share? What will be the cost of the share? The bonus shares are allotted free of cost. For example, recently on 22nd of October, Reliance had given the bonus shares. So what will be the cost? Now, I was, let's say, holding 30 shares of Reliance. I got another 30 shares in the ratio of 1:1. So what will be the cost of acquisition of the bonus shares? So if the bonus shares are allotted before 1st April of 2001, then the cost of acquisition is given under section 55. Let's see what it says. See, under 55, it says that in case the property in relation to any other capital asset where the capital asset becomes the property of the previous owner or the assessee before the 1st April 2001 means all the expenditure of capital nature incurred in making any additions or alterations to capital asset on or after the said date by the previous owner or the assessee, and in any other case means all the expenditure incurred of the capital nature and where the capital asset becomes the property of assessee by any of the modes under 49(1) by the previous owner. So basically what it is trying to say is that in relation to any capital asset which is becoming the property before 1st April of 2001, then in that particular case, the cost of acquisition shall be either the cost which is actually paid, which is in respect of any other capital asset. However, in respect of the bonus share, this is not applicable for bonus. This is for any other asset. So in relation to the bonus share, it will be the FMV as on 1st April 2001 or the actual cost which is paid. So if you see in relation to any other capital asset where the capital asset becomes the property before 1st April 2001 means the cost of acquisition of the asset to the assessee or the fair market value of the assessee of the asset on the 1st April 2001 at the option of the assessee. So either the cost or the FMV as on the 1st April 2001. But usually the cost of the bonus shares is nil. So therefore it will be nil or the FMV as on 1st April 2001. So obviously FMV as on 1st April 2001 will be beneficial. So assessee can take the FMV. The assessee can take the FMV. Are we clear? So therefore, in that particular case, if you acquire before 1st April 2001, this will be the nil or the FMV as on 1st April 2001 in respect of the bonus shares. Are we clear? Now, if you acquire after 1st April 2001, then you have to see whether it is allotted before 1st February 2018 or it is allotted after 1st February 2018. If it is allotted before 1st February 18 and if it is a listed share, so you have to see whether this is a listed share or not. So if it is a listed share, then you have a different way of calculating the cost. If it is not a listed share, then it will be any which ways a nil. So then again you have to check allotted before 1st February 2018. If it is allotted before 1st February 2018 and it is listed on which STT is paid at the time of transfer. Then in that particular case, the cost of acquisition in that case will be the actual cost which is there. Then in that particular case, it will be the actual cost which is there, which is in fact nil. Okay. Or the FMB as on 31st January 18. So you have to see the FMV as on 31st January 18 or the sale consideration, whatever is lower. So B or C, whatever lower will come, you have to compare it with the nil cost or FMV free as on 1/4/2001 if acquired before 1/4/2000, and you have to then take the higher of this. So are we getting this? So you have to compare the cost, which is nil, or the FMV if you have acquired the bonus prior to 2000. And you have to compare it with the FMV or the sale consideration FMV as on 31st January 18, whichever is lower. This is only in the case of bonus shares on which the STT is paid at the time of transfer. And if the bonus shares are allotted after 1st February 2018, the cost shall be nil. Are we clear? Now, what will be my period of holding? Period of holding will be from the date of allotment. So, period of holding of bonus share will be from the date of allotment. Are we clear? Any questions, any doubts before we close the session? Are we clear? Yes or no? Okay. So this is, yes, Ginny, you have some question?
Ma'am, I just want to ask, can you please provide the period of holding section under which it is given so that we can remember it?
242A. Period of holding is under 242A, explanation 1. It's the same as the rights issue because it says that if any financial asset is given to you, so from the date of allotment of financial asset, which is same applicable to the bonus and rights both.
Ma'am, every period of holding related information is given
242A.
242A. Okay, thank you, ma'am.
Yeah. Cost is under 49 and 55, period of holding under 242A. Okay, students. So that's all for today. Thank you so much, and we'll meet in the next class. Thank you. We can close the session. Yes. Thank you. Good night.